Good afternoon, everyone, and thank you for joining us on today's webinar, all about what you need to know about IR35. Today's presentation is brought to you by construction industry tax expert Liz Bridge and ECA's Director of Employment and Skills, Andrew Eldred, is also on the line. He'll be on hand to help with the Q&A at the end of the session. I'll shortly hand over to Andrew to kick off the session, but before I do that, just like to remind you all that you can use the question mark box that you can see on your screen at any time during today's presentation. I will see your questions and field them to Liz and Andrew at the end of the webinar. Today's session will be recorded and a full replay will be available on ECA's YouTube channel. That's at youtube.com/ECA Live. Be sure to also check out our wide range of videos and previous webinar replays over on our YouTube channel, covering a whole range of technical and business topics. And with that said, I hope you enjoy today's session, and over to you, Andrew.
Yes, thank you, Omar. I mean, just to add to what Omar said, I think I'd describe Liz accurately as the leading construction industry tax expert. She's provided advice and support to ECA and our members for many years now, and we've been very fortunate that she's been able to do that. She's also in regular contact with Revenue and Customs and HM Treasury, so I'm very much looking forward to what she's got to say in her presentation, to your questions and Liz's answers. So without further ado, over to you, Liz.
Hello. Well, we'll set off and let's go for the first slide. Right. Off-payroll working is a topic that you all clearly know about because you've arrived at the webinar. You probably know that the legislation that's behind it all starts on the 6th of April. It's got this rather dodgy title, off-payroll working. What does it mean? It means if your firm wasn't paying another company, partnership, business for the worker would actually be your employee. There's some sort of chain or even disguise in place to avoid pay as you earn, or to put intermediaries into a chain to break what looks like a master-servant relationship or an employer-employee relationship. And the legislation is being put into place to look through that chain. Next slide, please. Our employment practices in construction over the last 15 years have not been the best. About 15 years ago, there was an enormous push for improved pay-as-you-earn in construction. And what actually happened was we had the growth of all sorts of agencies and intermediaries who formed themselves, offering to take what might previously have ever been considered an employed workforce, take it away from its original employer, hand the workers back to him, miraculously sugar-coated as self-employed construction workers. We also had a recession, and at that point a lot of white-collar workers were taken off the payroll, made redundant or given early retirement, and then suddenly reappeared in sites and offices part-time, working as consultants and frequently working through their own limited companies. And so they were taken off the payroll and engaged as consultants. Again, they will be affected by this change of legislation. Go on, let's look at the next slide. So where did all these people go? Lots of them who were George Canning, you know, ordinary human beings, formed what are called personal service companies, and they formed George Canning Limited. Very frequently, actually, they are somebody's name with limited jammed on the end. Frequently, they have funny names like Holiday Fund or Imagination Limited. Intermediate agencies supplied the services of George Canning Limited. We have chains of agencies and intermediaries inserted to disguise the fact that George Canning is still at work for his original engager. Okay. So it may be that your firm pays George Canning Limited for the work of George Canning, being a human being you well know, and you're not actually running out a cheque to a human being, you're running out a cheque or a backs payment to a limited company, which is his. It wholly belongs to him. Next slide. It may be that you're paying an agency or an intermediary of some sort, and they're paying a limited company that's paying for him. There may be a whole chain of agencies and intermediaries before the loop comes back to George Canning Limited and George Canning. Next slide. So we've got to now think about the legislation that's coming in on the 6th of April and who it affects. It won't affect you all. It's actually being introduced for large and medium employers. And the definition of these are firms that have more than 50 employees, firms with a turnover of 10.2 million, or balance sheet assets of 5.1 million. And the wording of the law is you have to have two to be large or medium. But I would say to you, be very cautious. If you're anywhere near even one of those thresholds, I think you should make sure that you are clear of this legislation, you know what it is, and you've acted on it, because you will be looking now, your firm will grow, you may not look again, and you may not notice that you've crossed the 50 employees. If you're at 48, you won't notice when you cross 50. You won't, if your turnover is at 9.8, you won't notice when it passes 10.2. If you are close, if you pass one, treat this legislation as applying to you. If you are nowhere near this legislation, do not fall asleep. Just listen. It won't apply to you from the 6th of April. But this has been very, very successful legislation. It's new to large and medium employers. But 4 years ago, it was introduced for local authorities and government bodies. And it proved itself to be very, very successful. It's already shaking up large and medium employers. It is such a successful piece of legislation that I would put money on the fact that in another 2 years, it will be implemented for small employers. So I want everybody listening to watch and think, because even if you're too small for it to be going to operate on you at the moment, you should know it's about, and you should be watching your workers. Okay, so this is who it's going to hit: large and medium employers. Okay. Who are your off-payroll workers? My slide says that we're going to make a list of suspects. These are not necessarily the people that the legislation will bite on. These are the people I want you to test, who, if the revenue appeared in your offices, the people they'd be interested in looking at. You are not looking, and you do not put on your list of suspects anybody who's already on your payroll. And you do not have to put on the list anybody who comes from a genuine subcontractor where you have subcontracted a part of the action to somebody else. They are genuinely responsible for the quantity and quality of that part of the work, and they supervise and control their own workforce. So you don't rummage around somebody else's men who are being supervised and controlled carefully by somebody else, and where you're paying on a genuine subcontract. Those men may have to be tested by their own engager, but not by you. Okay, let's go to the next slide. See, that's who you're not looking for. The next slide is who you are looking for. Right. Regular faces. I want you to put on the list anybody whose face you regularly see, but is not on your payroll. Anyone with your firm's name on their business card or whose name is on your website. Anyone who wears your logos or indeed wears your provided clothes, or who sits somewhere regularly, even if that's one day a week. I want you to look out at your sites in your office and install the eyes of another in your head and think, who might a stranger think was your worker by what they're doing, by who they stand next to, supervision, any clue that they might appear to look like somebody that an outsider would think was your man or woman. Next slide. It's not the end of the list of suspects. Right. Anyone who has no other engager as far as you know, or very few. And I don't want you to cheat yourselves here. I want you to remember that all people running businesses have an ulcer. And I want you to listen to that ulcer. And if you're thinking about somebody and what you're saying to yourself is, well, he works for me an awful lot of the time, but I expect he works for somebody else at the weekends, or he has mentioned doing other. I want you to be sensible. If somebody's with you 4 days a week, 5 days a week, you can be pretty sure that they have very few other engagers. If they're semi-retired and they busily tell you about their allotment and they work for you, you can be fairly confident they have few other engagers. Anyone who previously worked for you in pay-as-you-earn and is doing the same-ish job but part-time. When you look at the lists of money going out on a regular basis, is there anybody that you know that limited company that you're paying on the list of payments out, you know it's a small limited company of a worker that works for you. You know, sometimes you know by the name, but but you may have insider knowledge that you know it's their own limited company. Onto the list of suspects, anyone that you've asked to work for you because you liked their skill set, or you liked them, and you actually specifically asked them to come. Okay, next slide. And these usually give me an ulcer because I talk to people and they talk about them. Anybody that isn't on your payroll, but you insure to drive your vehicles, or you give holiday pay of sorts or allowances to for holidays. Anybody you train, anybody who comes to your Christmas party on a regular basis. I don't mean wives and girlfriends or partners. I mean, you know them well enough to invite them to your Christmas party. And then anybody who you think might loosely describe themselves as working for you. Inland Revenue staff don't live in isolation in a forest, only talking to one another. They live in the community beside us all. And if they've stood up in a bar somewhere a long time ago now and talked to somebody who described themselves as working for you, it's always interesting to look at the payroll and see that person's not there. Just think how your workers would describe themselves, and anybody in that category, put them on your list of suspects, because I want you to zest test them. We'll come to that. So let's go on to the next slide. Why are they dangerous? Right. You have this legislation looks at workers who have their own limited company. Whoever pays that limited company, directly pays that limited company, in the law is called the fee payer. And this legislation says that the fee payer must apply pay as you earn to the fee paid to the limited company when the worker is in a chain where at the end, when he's doing his work, he should be an employee. So although the worker is on your sites and your offices, the fee payer must apply pay as you earn. And if the fee payer doesn't apply pay as you earn, the liability pops back along the chain to you, the firm that used the person. So at the moment, you pay another who pays another who pays a worker, and you tell yourselves you're not responsible for pay as you earn because you pay another who pays the worker. This legislation says if pay as you earn isn't in that chain, the liability passes straight back to you. So it's nasty legislation. Go on to the next slide. In the longer chains, where you pay a business which pays another business, which is the fee payer, and that fee payer pays the personal service company which pays the person. If pay as you earn is not applied by the fee payer, your firm is responsible. I'm saying it twice because I want it to drill in. You are the user of the worker. The human being shuffles around your sites and offices. His humanity is next to you. And if pay as you earn isn't in that chain, you are responsible for that uncollected pay as you earn. Okay, next slide. So the buck passes, this third time, the buck passes to you. But let's say in most cases you are the fee payer, the vast number of people or firms caught by this legislation, actually the chain is quite short. You're paying a limited company where there's only one person working for the limited company, and that's the worker you see. There may be limited companies which are husband and wife owned, and that, you know, she's a director or a shareholder, but that or he is, but that there is one real worker in the limited company, and you're paying a limited company who's paying them. That is the most frequently seen situation. Next slide. So you've got your list of suspects, and I want your suspect list to be, when I say to be as big as possible, I don't want anybody that should be tested to be off that list. It's a list of suspects. It doesn't mean you have to operate pay as you earn for these people. It merely means you have to test them. You go online and you Google search HMRC zest. And what you find is an interactive test. It's anonymous. I can't stress this enough. The Inland Revenue can't see through the screen to you. They are not testing your IP address and finding out who's using the zest test. It's a game that you can play alone. And so when you go into it, answer the questions truthfully and test each of your list of suspects. If you lie, fib, squeeze the truth, the person you're cheating is yourself, because you're going to get the answer you want, but down the line, when the revenue arrive, should they ever do so, they won't get the same answer that you did. It's important to know the extent of a problem before you handle it. So as you start using your zest test, remember it's anonymous and use it as truthfully as you can to find the extent of your problem. When you're being truthful with your list of suspects, some people will come up as self-employed. You go back in, you type their name, you do the test again, and you print it out, because you have got a passport then. Keen on passports at the moment, aren't we? You have a passport that you zest tested that person and that they were not an employee. And you know that you were entirely truthful. And they're off the list of suspects safely. You will then get some answers that show employee or undecided. And you have got to think what, as a business, you are going to do about those answers. You will have learnt the zest test as you play with it. You will have learnt that there will be answers where you can squeeze. If you do that, you must change the relationship you have with that person to accord with what you have learnt from the zest test. I do not want you giving a zest test an answer, but continuing in an old relationship with somebody. the zest test has told you how the relationship would have to be changed to ensure self-employment, and you must be sure that that's what you do in practice from now on. It will also give you some employees. Let's go on to the next slide. So, off-payroll rules do not apply. You have reached a place of safety, you log it with the person's name you print and keep. Off-payroll rules do apply. Right. And you aren't going to squeeze, because what you're looking at in some cases is a group of workers who you'll know, listening to your ulcer, work on very similar terms on site to your pay-as-you-earn workers. You've got pay-as-you-earn scaffolders, and you've got scaffolders coming in through some intermediary. They're indistinguishable to the public eye, other than the way they're paid. Right. You're large, so the off-payroll rules apply. You tell the firm you pay for the person's services that you have tested the worker and that you have found them to be an employee, and that pay-as-you-earn must be applied within the chain within 45 days. It isn't happy news, and you are going to have to expect consequences. But you must, having done a zest test, where the decision is employee, you are obliged to tell the firm you pay, and then wait for the knock-on effects, because you need to be assured that pay-as-you-earn is in that chain now, because if it isn't, you're liable for it. You must keep proof that you've told the chain. Right, next slide. So, you've done a test on somebody where you are the payer of a limited, you're payer of George Canning Limited. You are the fee payer. You tell George Canning Limited, I've tested George Canning. He appears to be an employee. I am going to apply pay as you earn, because I am the fee payer. I am the firm that pays the limited company that pays George Canning. There may be situations where you don't actually know that the limited company you pay is a personal service company. You get George Canning. You don't know when you pay, I don't know, Bag Limited, whether Bag Limited has lots of employees or just the one. You probably do know, but let's say you don't. You will tell George Canning Limited that pay as you earn has got to be applied in this chain. Would they tell you whether they are a personal search company? And they'll tell you. That is their legal responsibility to tell you that what is going on. Okay, next slide. You've tested the person, you're telling an agency, an intermediary, they become the fee payer, they're to apply the pay as you earn. But you do the tests, you tell the chain. Okay? Some of these chains are long, but not often. Go on, sorry, go on. What if you do if you receive a notice? I'm going to slide past this slide onto the next one, because I very much doubt that your agency is listening to this. What if you receive an employment status determination and do nothing? You become the fee payer. So if you send somebody a notice and they do nothing, they become legally responsible. everybody in this chain once these notices have started to flow, legal responsibility for pay as you earn starts to become terribly infectious, and that it's a sort of game like pass the parcel, where the parcel is explosive. It mustn't be in your hands and not passed on. As soon as you receive it, you pass it on and you act upon it. Okay, next slide. Right, what must the fee payer do? Now, the fee payer is, of course, the person that pays the personal service company. So it's the business that pays George Canning Limited for the work of George Canning. They must, when I say operate pay as you earn, they must calculate the direct payment and account for employment taxes and national insurance. They must deduct those taxes. They must pay employers' national insurance contribution, and the employment allowance can't be used for this. They must report using RTI what they've done, and they must apply the apprenticeship levy. And it doesn't matter when the work was done. Don't go down that rabbit hole. Once you're running a payment out, who cares when the work was done? You're running a payment out. Okay. What do you apply the pay as you earn to? So let's say you've got somebody working for you through their own limited company, and let's say that limited company is VAT registered. It's a proper, you've always had it in the past as a proper contractual payment. You slip off the VAT. So in fact, as of the 1st of March, the VAT is probably reverse charged and isn't there, but you would separate off the VAT. You could separate off the direct cost of materials they'd used. I want to seamlessly pass the next one, actually. Deduct any expenses met by the intermediary that would have been deductible if the worker had been in employment. There aren't any. Okay, I want you to say to yourself, although that's there won't be any. And you would apply pay as you earn to what was left. So the man has come along working for his own limited company. Let us say he's a scaffolder, but he happens to have brought with him, I don't know what, some clips. He's charged you for the clips. So you take off the clips, you apply pay as you earn to the balance, and employers pay as you earn as well. You look at the net pay, you add back the materials, you add back any VAT he's charged correctly, should have been reversed, I think, and you pay him what you owe. And as you can probably tell, it's a mess. Next slide. How would you actually do it? Within your own payroll, you'd set up what's called a department, a personal service company department. So anybody that you were paying through a limited company, you'd keep them together and slightly away from your own workforce. There's a starter declaration C of secondary employment. You tick it was an irregular payment pattern with a payment frequency that would match the contract as far as possible. And you'd run out a P45 as normal when the contract ends. Next slide. Right. I want us for a moment to think about what would actually happen. You've got a human being who actually works for you, who you've always paid through their limited company. And you have never paid the employer's national insurance, and they haven't paid pay as you earn, very probably. They have probably paid themselves a minimum wage and taken the rest as dividends to reduce the national insurance bill. And now what we've got is that the payment that their limited company is receiving is far lower because there's national insurance deducted, and your costs have risen because you've got employers' national insurance back in the mix. So the whole thing is much more costly. You've got national insurance contribution. He's got less take-home pay. And if there's an intermediary or an agency in the chain, you'll be paying them a turn. And what are you getting in exchange for your money? Because you've got to pay national insurance contribution. Once you tell somebody, once you do a assess test and you pass the message down that the person is an employee, you should be letting loose Pandora's box of worms. The message should be responded to by protests and by the request for more money. The worker will not like to work for you for less take-home pay than they are getting now. The intermediate agency will not want to supply you with a worker when they've suddenly got to pay employers' national insurance contribution unless you pay them more money. If, when you tell the chain that you've observed that you are being supplied with a worker, if at that point the whole chain goes quiet and nothing happens, I think you can be fairly certain that nothing is happening and that no pay as you earn is being applied. Because if pay as you earn was being applied, there would be a lot of squealing. So if there's silence, you must be very suspicious and frightened, because if pay as you earn isn't being applied down this chain, the liability is yours, you aren't costing it, and it may come home to bite you, and you've never put it into your margins. So be very frightened by silence if you tell a chain that there's an employee in there and you want pay as you earn applied. Right, if you tell a chain that there's an employee in there and you want pay as you earn applied, what is this chain worth to everybody down the chain? What's it worth to you? Because you aren't avoiding pay as you earn. So what are you getting for the turn that you're paying and the fuss? Is it worth putting that worker back into pay as you earn? You have to think about it. With the next slide. If the chain does apply pay as you earn to these payments, you are not responsible for the deduction of student loan repayments, and nor is anybody in the chain. And the worker, strangely enough, although they have pay as you earn deducted from the payments, they have no rights to holiday pay, no entitlement to statutory payments, and no auto enrolment for pension. So if they were in your pay as you earn system, they'd have all that, and you'd have responsibility for all that. If they're sort of held continuously offshore in these arrangements, they suffer the deduction of pay as you earn and national insurance, and they don't get what you might think of as the bunts that comes with it. If it was me, I wouldn't be that happy about that. So you are going to have to work on the HR consequences of these chains when you find them, and discuss with people what the new prices are and what they want to do. And I have no easy answers for you. I'm trying to show you where the new legislation poses a danger to you, and you have to work through that problem and try and get people onto new footings. But don't think that silence is golden, because once you've told somebody that you've done a test and they're an employee, silence is going to be a bit scary. And you are going to have to know that there is pay as you earn in those chains. Let's have a look at the next slide. I think it's the last one. Right, the best public guidance, you start at this point, the fee payer responsibilities under the payroll working rules, and then you follow down various rabbit holes. Don't just go down the rabbit holes though. I want you to really concentrate on that ulcer and on that list of suspects, because that is your best guidance to where your problems are and what you have to do. Because once you look at the list of suspects and engage your ulcer, you may well know who are the genuinely self-employed workers who do just come and go, and who you know in your heart are servants held at arm's length. You have to be sure that there is pay as you earn down these chains once you've worked out that there is an employee about. How are you going to do that? You have to have intermediaries you trust. I would say at the start of this, you have to have evidence of a payroll working. I would always test at least once a year and ask for evidence that there was pay as you earn being applied. A spot test of the workers involved, and ask them who engage, who's actually paying them their money, and is there pay as you earn in there? They'll know. And I would say this is something ongoing, because you do not want to pay a smart and fast and loose intermediary who at the start of this tells you one thing and then starts to do another. And you go on happily trusting because it's cheap, only to find that you were lured into liability. And at that point, I'm going to stop because I'll have frightened you all witless. And we'll have a little look at the questions.
Thank you very much, Liz, for your presentation, and thanks to the audience for submitting your questions. Just a reminder that you can still submit questions just click on the question mark on your screen and you can type in your question there. Before I dive into the audience questions, Andrew, I believe you had a few words.
Yeah, I mean, thanks, Liz. You talked about being frightened. I mean, it is a complex area and therefore potentially frightening area. My question is that quite a lot of our members are getting mail shots and so on from all sorts of people, tax advisors, intermediaries and so on, assuring them that they've got a surefire way of ensuring that people can switch from a personal service company to some other method of engagement. I mean, what's your take on that? And you know, are there risks that you can identify with taking that course of action?
You don't have to think that there's science in this. You have to listen to that ulcer. If that person works for you, and to the ulcer, to you, when you look at them, you think they're your employee, it's a very interesting magical turn that somebody's doing to take them and give them back to you as a self-employed at self-employed prices. What is the intermediary doing? They are running through carefully worded contracts which they hope will circumvent the legislation with contractual terms. Have your doubts, because if push came to shove and a member of the Inland Revenue staff came to your offices and got hold of this worker and actually asked them for details of how they worked and who they worked for, you have to imagine what they'd say. And would they be fully informed, or would they say, well, I work for, and give your name, and he told me who to go to, and I've been paid by this payroll company, and I've never understood what an umbrella was, and I just do what I'm told. Think how it would come out, because yesterday I read the full transcripts of the Supreme Court looking at Uber drivers, and what the courts are doing more and more and more is saying it doesn't matter a bean when the contractual terms are artificial. We will always look at the evidence given to us by the working parties, and that will supersede strange contractual terms. The courts will focus and put weight on what was done in practice. So when people offer you schemes that magically turn workers into self-employed workers, be cautious, especially when the chains often have very young men with companies in them with no share capital, very often have intermediaries offshore, very often have documents where QCs have said that they're absolutely certain that the terms work. The QC would never have to put his money where his mouth was. If everything wound up, everybody in the chain would disappear quietly, having taken all their money out in terms of directors' remuneration, and the only liability left in the pot would be yours. So be careful. Okay. Anybody else want to ask?
So I'll dive into the questions from the audience. The first one is, are there some roles that automatically fall outside IR35 that we don't need a statement of determination for, e.g. carpenters?
No, there's no role that automatically falls outside. You know, if you have a carpenter who's there and you tell him what to do and you give him the pile of wood and you watch him every day, of the week, he's an employee. It doesn't matter how you got him. You test everybody. That what that question is telling me is that somebody has a very unpleasant, their ulcer is banging around saying, carpenters, carpenters. Yes, test them.
Thank you. Another question here, is it the end client size that determines if IR35 applies? As an intermediary, we are smaller than the threshold.
If
I'm not
you're
sure if sorry, go ahead.
go on.
I'm not sure if I got that question, accurately, but please do go on.
Yes, well, I'm not sure I understand the question either.
We may come back to that one later if that helps. And by the way, just a broader note to say that if we don't get around to your question today, we will be making efforts to reach out to you directly, and we'll answer your questions directly after the webinar if we don't cover them today. But we'll put a pin in that one for now, and I will move down the list onto the next audience question. Do we still add VAT back to payment if the charge is subject to reverse charge VAT, which of course came into effect at the beginning of this month?
No. So let's say you have a subcontractor who works for you through his own limited company, and he's VAT registered. The chances are that as of Monday, he will reverse charge you anyway, because you're all VAT registered CIS businesses and not likely to be end users. So your subcontractors should be reverse charging you, sort of as a general rule of thumb. So you will get from him a reverse charged invoice. And therefore, in a way, what you take off is the materials element that's in that invoice, if there is one, and you'd apply pay as you earn to the balance. And there wouldn't be any VAT to add back because it's reverse charged, and you would use that, you'd use the whole reverse charge onto your return. So you treat the VAT as you would normally, not normally in February, normally in March. I don't know whether I'm very clear about that at all. If, for example, he did charge you VAT because you were the end user, let's say that he's come to do some repairs to your offices and you are the end user, you would strip off the VAT, apply the pay as you earn to the payment, give him his take-home pay after the pay as you earn, add the VAT on and give it back to him. Horrible, horrible exercise.
Thank you. Next audience question. Is there any timescale for when HMRC will start running investigations, or will they do this month by month via information received?
We're all in the middle of a pandemic. Who knows what we'll be doing? They've said that for the first year, they will be behaving in a civilized fashion and soft landing this. So I don't think you need to panic that you haven't done your zest tests by the 6th of April, but I don't think you should leave it. I think this is an exercise where you get the list of suspects, you do the exercise, you try and work out which men are working through personal service companies, and you become aware of the fact that how big is your workforce that could potentially come into pay as you earn, and that is the way the wind is blowing, and what are you going to do about it? So you'll move the ones that are working for their own limited companies, but you'll be aware of the fact that there are others. Now, some of them will be working through agencies and intermediaries CIS, and just are ordinary men. And when you've zest tested them, they look like employees. be aware that that's a bit dodgy. It's a time for looking at the size of the problem and thinking about how you're going to trade over the next year, how you're going to handle it, and knowing that if you're large and medium and that there are men working through limited companies, those specifically have got to be handled. Yeah, this one.
Thank you. So you touched there upon the links between CIS and IR35. We've got a question here saying, how does CIS integrate with IR35? So is there anything you wanted to add on that point?
Once you're applying pay as you earn to a payment, you don't apply CIS. The person has come in to pay as you earn, and you don't need to apply CIS. Even though you're saying to yourself, but this is a construction industry payment, it has become a pay as you earn payment, and that tax takes priority. Okay.
Thank you. We've got a broader question here. So do the new IR35 rules apply to sole trader, self-employed subcontractors who are not limited?
No, it doesn't. But that's where I'm saying you do your list of suspects, because you don't always know how people are paid. Well, you know that if I'm on a building site and my name's Elizabeth Bridge and you run a payment out to Elizabeth Bridge, you know Elizabeth Bridge got it. But sometimes you'll run a payment out to Elizabeth Bridge Limited, and then you can have a good guess that I'm working through my own personal service company. You might run a payment out to Bridge Electrical and Imaginative Services Limited. Now, you might guess that's my personal service company. It may be a business run by my father and the whole family are in it. It might be a pure coincidence, and that might be an agency or an intermediary. You don't know. What you've got is a list of suspects where, when you did a test, some men turned up to be employees. If you're paying them straight CIS and you think there's no chain there at all, actually you've revealed to yourself that you've got a problem and that you ought to think about whether you just put them into pay as you earn, because they're probably not self-employed at all. If you're paying somebody else, you tell them, because it's only the somebody else who'll know how that man is paid. You've got to do your zest tests. You've got to find out about the chains that you're paying, where the human being in law looks like your worker. You've got to find out how they get their money. And know much more about it. You know, that people who are your servants have got, the chain has got to be told, that looks like that seems to test as a servant what's happening.
Thank you. We're coming up to the hour. We'll cover just one or two more questions, so we'll overrun very, very slightly. And as I mentioned before, this webinar has been recorded and will be available on ECA's YouTube channel, youtube.com/ECA Live. And those questions we haven't got around to answering today, we will make efforts to get back to you separately via email. So final question here. The construction industry by nature needs a pool of subcontractors to suit the peaks and troughs caused by orders and programs. Will this legislation reduce the subcontract pool and in turn give the industry a big resourcing problem?
I don't think any of us know, because in all honesty, we can't say, oh, we need casual workers and we need those casual workers kept out of pay as you earn. I mean, hotels need casual workers, bars need casual workers. They always apply pay as you earn. We have workers and we do need casuals. What the government says is, you know, if you have a casual and he works for you under your direction and control, his wages have to go through pay as you earn. There's nothing in that statement that says you can't have them. It's that they have to be properly taxed and properly national insuranced. And that's not what's happening. When we come out of the pandemic, I suspect there'll be a lot of people who want jobs, possibly untrained people who want jobs. But we don't know where we'll be.
Thanks.
I don't mind if I don't know how whether your webinar actually always folds at the end of an hour. I'll stay on if anybody wants to go on talking to me. I don't mind.
We can cover one last question and then wrap up the session.
Okay.
So a final audience question here. If a small company is using an agency to provide labour, but the agency is a large company, does that mean that as a small company, PAYE and national insurance will apply?
It doesn't matter the size of either of the parties. You look at the men working for you who are buzzing around your sites and offices, and you write your list of suspects, and then you zest test them. And if they fail a zest test like they're an employee, you tell whoever you got them from, I have zest tested this person and they look like an employee. Is there pay as you earn in this chain? And it's as difficult and as simple as that. That has to be pay as you earn in the chain. If at the end of the chain, there's a fee payer, a personal service company, and a person working for their own service company. But you won't know that. Or not necessarily, you'll need to tell the agency, I looked at this person, I looked at how I'm engaging them. They look like an employee when I've zest tested them. What are you doing about it? It may be that the agency will come straight back to you and say, actually, we have a pay-as-you-earn role, and they're in pay-as-you-earn already. You don't know what you're going to be told. But you look at your list of suspects and you zest test.